Of TFNN. Trade what you see with Larry Pesavento. Call now, toll free at 1-877-927-6648 or internationally at 727-873-7618. Now, Larry Pesavento.
Okay, looking good, Billy Ray, feeling good, Lewis. Our special guest today will be John Jameson. Before John gets on, I'm going to give him a tiny introduction. I met him in 2005. He flew from Perth, Australia, out here to Cowboy Land and spent, I think about 10 days with me. We got along pretty good, and then since that time, we've been good friends. But about 5 years ago, I think it was 2016, he was kind enough to take me under his wing. And for the next few years, we studied quite a bit. And then 24 months ago, he really took me under his wing. And we've been working 7 days a week. It's not been work. It's been fun. But he's taught me more in those 3 years than any other time period that I've learned. That's 61 years, folks. This is an infomercial today. He doesn't have anything to sell. I have never invested in a cryptocurrency. I'm not one of his clients. But what he's told me is a story that started way back in 2017 when Bitcoin was on its way to 20,000. When it got to 20,000 and was on the Merc, listed at the Merc, he said it was going to drop by 80%. It went to 3,000. Then he told me it was going to go to above 50,000. It went to 65,000. At 65,000, he told me it was going to go in half or maybe even more. And I told him when it got to 65,000, if that happens, we have to get in touch with some people because I've been very skeptical about this. What he's going to is his story about the people that started this whole thing. John, you are on the air. You have the mic. The one thing you told me, John, more than anything else, it's not what you think, it's how you think. And I want to thank you for that because it's changed my life. Go ahead, my friend. You've got the mic.
Thanks very much, Larry. You can hear me okay, yeah?
Yeah, perfect. Everything's great.
Okay, I thought what we do today is just go through cryptocurrency. You know, why people, when they're looking at Bitcoin, might be missing the point. So why don't I just get started because there's a ton of stuff to go through. And maybe at the end, if we have any questions, we'll take them then. In the meantime, if you've got anything to say to me, please interrupt me. Don't let me rattle on here on my own for a best part of an hour if there's something needs to be said. So is that okay with you?
Fat chance of that, but keep going.
Okay, well, here we go. So first up, if you stick around today, over the next 45 minutes to an hour or so, I'm going to give you a crypto pick at the end of that. So if you don't know which way's up regarding crypto, or if you've stayed out of it because of all of the noise around Bitcoin, then I'll give you a pick at the end. But better than that, at the end, you'll know the reason why you picked it. And second, for any of the doomsayers out there, I'm going to give you a fast and frugal mechanism to know when Bitcoin is bid. So stick around for that too. All right, well, let's get into it then. So have you ever purchased a cryptocurrency? And if you have, how did you decide? Was it some comment and quote guru endlessly going over the same factoids? And there are tons of those, tons of them on the internet. Or did you do the analysis yourself? Do you only use technical analysis to make your decisions? So if you do use technical analysis and only technical analysis on things like cryptocurrency, if you're looking at charts only, let's invert the Hunger Games here. Because if you're going to stick with crypto over the long term and you're only using technical analysis, then the odds of long-term success are forever not in your favor. Why? Well, it's because crypto, unless you haven't noticed, is extremely volatile. And in my opinion, if you do trade it with leverage, you are insane. Why? Because you don't need to use it. Now, we'll cover a little bit more about that later on. So the question is, if you know, why don't you know? So things like this are why 99% of people struggle to make money over the long term in crypto. Now, again, more about that in a few minutes, but first, why listen to me? Well, a year ago last March, for every $10,000 invested in one of my recommendations, that's now worth $436,000. Why? Because that section of my crypto portfolio is up 4,366% over the last 15 months. Now, that sounds almost unbelievable, but think about this. 46 days ago, That same $10,000 section of my crypto portfolio had a mark-to-market value of over $836,000. That's an 8,266% increase. Now, unless you're insane, you're going to need a lot more than the chart if you're going to hold on to this thing over the long term. If you're going to hold through the volatility that is guaranteed to come your way when investing in cryptocurrencies, you're going to need to understand what is driving this train. Gains, opportunities like this are incredibly rare, especially now that venture capitalists hold on to companies much, much longer than they used to, extracting every ounce of value from those companies before floating them to the public. And there's an upside twist here when you're investing in crypto, and that is, here's the thing. Cryptocurrencies, even today in July 2021, are still available at pre-IPO venture capital prices. Prices that, unless you are a multi-millionaire several times over, you wouldn't have access to in the stock market. For example, Paul Hewson is not only a great songwriter and musician, he's a great investor too. And in 2009, he purchased a 2.3% stake in Facebook, which was valued at over 86 million, I believe, through Elevation Partners. Selling out in 2015, Hewson made billions. In fact, it was reported at the time that he has made more money from his Facebook investment than from all of his songwriting and recording royalties. Now, this presupposes that Hewson must be a pretty good songwriter, and he is. You know him better by his stage name, Bono. But unlike Bono, it's doubtful you'll be privately invited to invest in a big-name IPO unless you are an extremely wealthy individual who is well-connected. For the rest of us, the May 2012 IPO of Facebook was your first opportunity to invest in it. But as has been the trend over the past couple of decades, venture capitalists are delaying these public offerings, milking every ounce out of them before they make them public. So in May 2012, you had the opportunity to buy that for $38. Now, at this price, Facebook was selling at a price-to-sales ratio of 100. If you've ever watched Shark Tank, you'll know that that isn't good. In fact, at $38, you are taking all the risk. So the big takeaway here, and the big twist with cryptocurrency, is this. With crypto, over the past few years, you've been able to invest in this technology at essentially pre-IPO private equity prices. And the good news is you still can. So the trick is finding the technology most likely to succeed. And that's what we're going to go over today. Counterfactual, fast and frugal thinking is the key to solving this problem. Now, I'm a professional writer and an art historian, but don't worry, just in case you think you're listening to the wrong show, you're not. So I first purchased a Bitcoin back in 2015, and I paid $120 for it. Now, at the time, I thought I was mad. So as friends of mine had purchased theirs about a year earlier for around $6. So I thought I was pretty late to the party, but it turns out I wasn't. So 3 months after I bought Bitcoin, I was sitting on an 871% gain after Bitcoin hit $1,000. So with those kind of gains, what do you do? See, if you sell, you lose your entry. You have to sit there and take notice. And remember, I'm a professional writer, and that means that I write around 500,000 words a year for my own projects and for my clients. That's around 40 to 50,000 words a month. That's commercially complete work. If you include all the drafts, it's a lot more than that. So I have several friends who work in the city. And in fact, that's how I originally met Larry. Luckily for me, right back at the beginning, a friend of mine recommended a trading book that you probably heard of and probably even read, and that's Reminiscences of a Stock Operator. Chapter 5 begins like this. The average ticker hound, or as they used to call him, tapeworm, goes wrong. And then it goes on. And a quote from there. This is a quote from the book. It was a long step forward in my trading education when I realized at last, when old Mr. Partridge kept on telling all the customers, well, you know this is a bull market. He really meant to tell them that the big money was not in the individual fluctuations, but in the main movements. And that is not in reading the tape, but in sizing up the entire market and its trend. It was never my thinking that made the big money. It was always my sitting, end quote. Well, in Bitcoin, I sat. My $120 entry was never taken out, but I had to wait 2 years before the next leg higher began, and that took Bitcoin from $250 to just under $20,000. So the only question is now, if you're not involved in cryptocurrencies and you're looking to get in, are you turning up dazed and confused at 3 a.m., looking for action, finding nothing but detritus, kicking bottles and cigarette stubs on the floor of the party hours after the in-crowd has left? Or in your delirium, have you turned up at the wrong house a day early? Well, I'm betting that you've turned up at the wrong house a day early. So let's find out why. Well, if you want to make money in Bitcoin, you're going to have to hold through huge swings. And if to do that, you really do need to understand what is driving the underlying trend. So first of all, let's have a brief run through Bitcoin and the previous bubbles. So in the last 12 years, it's had 5. It took nearly 9 years for crypto to get into the general public's awareness. So in July 2021, as I've said, you might think you've missed the party. But for all the media hype, what if this party is only just getting started? And what if, even now, cryptocurrency and blockchains are still in the early adopter phase? So to prove this to yourself, do a social experiment. Now we're all coming out of lockdown. The next time you're at a party or socializing, just ask somebody, what is a Bitcoin? Or better yet, ask them what is a blockchain. Even now in 2021, be prepared for blank faces, shrugs, or even wild guesses. Trends end when everyone from your accountant to your barber is in on the action. And the last time I was at the barber's, I asked mine. I asked him, what is a blockchain? He just looked at me and said, I have no idea. So bubble number 1, between October 2010 and July 2011, Bitcoin traded from 1 cent up to $32. That's an increase of 319,000%. But between June 2011 and November 2011, it lost almost 94% of its value. And on the 14th of November 2011, it was back at trading at $1.99. Bubble number 2, from this $1.99 low, it took 20 months to trade back up to $32. So after Bitcoin broke above the previous high, it quickly moved from $32 to $266 in the first week of April 2013, and in a move that took just 6 weeks. A good axiom to work with is this: when the only way is up, the only way is down. And from $266 in April 2013, Bitcoin dropped 75% back down to $65. Everyone caught up in that 6-week frenzy took a hit. And that's why it's difficult to learn how to be a successful speculator over the long term. It's really, really difficult to hold on to big swings. Prices go up when demand outstrips supply. And I know this is a tired cliche. Everyone says it, but very few people understand the implications of this phenomenon. So, for example, if a large percentage of available supply is not for sale, then buyers obviously are going to raise their bids to compete for the asset. So in April 2013, from a low of $65, it took 7 months for Bitcoin to hit $1,163, an increase of 1,677%. Again, when the only way is up, the only way is down. So after hitting this high, Bitcoin started down. Bitcoin made an all-time high of $1,163 on the 4th of December 2013, but over the next 13 months, it traded lower, hitting a bottom of $152, a drop of 86.89%. Then it died, and that was the first time the media got hold of it and saying that it was a bubble and it was, that was it. Thanks for coming, it's over. Rest in peace, Bitcoin. Now, from the January 2015 low, Bitcoin started its run, a run that ended at $19,666. That's an increase from that low of 12,800%. But if you bought at that low, on the way to 19,000 or above 19,000, you would have had to sit through, between July and August 2015, a 37% decline. In the week of November 2nd, 2015, a 41% decline. Between the 13th of June and the 1st of August 2016, another 40% decline. In the week of the 2nd of January 2017, another 34% decline. Between March the 6th and March the 20th, 2017, another 34% decline. Between the 12th of June and the 10th of June 2017, another 40% decline. Between the 28th of August 2017 and the 11th of September 2017, another 40% decline. And finally, in the week of November, at the end of November 2017, a decline of minus 21. But did you notice something? Look how consistent all those drops were, except for the last one. It was around 50% of all the others, and that's a sign of a parabolic ending move. But it's easy to look back in hindsight. It's easy. And psychologically, though, the experience of losing money is 250% more intense than the experience of making it. The only question that matters is, did you hold on? Can you hold on? Very few can buy at the low, but fewer still can hold through these swings. Now, bubble number 5 arguably ended at the recent $64,000 high. And many people think the cryptocurrencies, especially Bitcoin, are on their way back to zero. Good riddance, massive bubble, I told you so. Well, when looking at Bitcoin's price on a normal arithmetic scale, it's easy to see why. However, if you change the scale to log, you'll see something else. You'll see a bullish condition. You'll see something that's sitting quite happily on its way down to a log scale 382. And that's the inherent weakness of using a chart. It can, if you're not careful, tell you what you want to hear. Now, fundamentally, as for Bitcoin, do you, or any crypto for that matter, do you understand how they work? Do you understand the strengths and the weaknesses of proof-of-stake network validation over proof of work? Do you understand the advantages of a decentralized network infrastructure over a centralized one? Do you understand how data packets are transmitted over packet-switched networks? Because if you don't, you're at a serious disadvantage to those who do. Why? Because you will have zero idea of how value is created across computer networks. Yes, a chart will give you opportunities to buy and sell, but a chart can never tell you why, and it can never reveal underlying value. A chart is convenient and is a relatively easy skill to learn compared with being proficient at market valuation. Now, this is a trade-off you make when you just use charts for decision-making. Remember, we're talking about Bitcoin because we're talking about bubbles here, and in 12 years, Bitcoin has had 5. Some people argue that whether the last high is a bubble high, but we're down 50% from that high, so it qualifies. Now, in late 2017, Bitcoin hit an all-time high of 19,666. The only way was up, except it wasn't. Bitcoin entered a bear market lasting 2 years and 3 months. Now, it lost 84.12% on that drop in making a low in December 2018. You had another multi-month rally off that low, but it collapsed back to test that low. Last year, in March 2020, you were given a gift. If you understand how to value networks, and we're going to cover that in a few minutes. So Bitcoin hit a low last year of $3,850. Understanding how to value digital network assets allowed you to see the gift you were being offered. Now, using a chart, you can never reach this level of insight. And as we've just said, it is a trade-off between the simplicity of reading it and the ability to trade anything and everything without needing to understand the fundamentals. The downside of this is you have no future point of reference regarding valuation. So, for example, if you believe Bitcoin is still undervalued at $100,000, holding the core of your crypto portfolio is much easier when the inevitable sell-offs come. But if you've no clue regarding valuation and you purchase your crypto because some Johnny-come-lately in a beanie on YouTube told you to buy it, holding through the downswings will be much, much more difficult. Because as you see your money evaporate, your state of mind will be focused on how to protect it and how to recover your losses, precisely the opposite of somebody who understands value, who is giving a nod to the gods and saying thank you for the opportunity to buy more. Now, with Bitcoin trading at $64,895 at its all-time high, Bitcoin had gone up 1,585% from the March 2020 low. But those 2013 Bitcoins purchased at $120 are up 53,979%. That is the power of sitting. Now, believe it or not, that is nothing compared to some of the altcoins, some of which, believe it or not, are up hundreds of thousands of percent. So how do you hold? How do you hold? It is not easy unless you understand one thing, the driver of the underlying trend. So let's talk about that for a minute, because history makes it seem like it's easy to pick the winner. So think of cryptocurrencies. To begin this, let's do something here. Let's, instead of trying to go down the rabbit hole that is the technology side, I've always found it much more effective to stay in the macro rather than the micro. So for now, think of cryptocurrencies as a solution looking for a problem to solve. For example, lots of things get invented, but they have to wait quite a while before society finds a use for them. For example, in the 1st century AD, Hero of Alexandria described a device in Roman Egypt. It was known as Hero's Iridiophile, and it's considered to be the first steam-powered steam engine. A steam engine. Now, by the early 19th century, that's how long it took for things to start happening, carriages for personal use had been developed. First by a Polish engineer in 1815, then by an American in 1825, and then things went quiet. Suddenly, out of nowhere, from 1859, steam cars were being manufactured all over the world, in the US, in England, Italy, Canada, France, and Switzerland. And by the 1880s, familiar names had started to appear, names like Peugeot, for example, in 1889 manufactured its first steam-powered car. So between 1900 and 1910, hundreds of new startup companies started making automobiles using steam, gasoline, and even electric-powered cars. It's easy for us to look from history at our perspective and see this unravel in fast motion. It's obvious now that the petroleum-powered internal combustion engine superseded the use of steam-powered external combustion engines. But if you go back to the earlier 20th century, things looked very, very different when you looked at them in real time. Because in those early days, nobody knew what an automobile should look like. And that is exactly the right way to think about cryptocurrencies today. Blockchains are solutions looking for real-world problems to solve, but nobody really knows the best use case for them. And this is why they are still available at pre-IPO prices, or that's one reason why. So back to cars. Most early designs look like horse-drawn carriages without a horse. And the most promising design in 1907, a vehicle which could go 127 miles an hour, which was a world record then. It wasn't powered by gasoline, it was powered by steam. And if you could go back in time to the earlier 20th century, you'd see why steam-powered cars would make sense, because it's obvious. In the early 1900s, the world was in steampunk mode. It was driven by coal and steam. So, of course, everyone knows Henry Ford as the victor. We all know the story of the Model T in 1908 and the production line, etc. But so let's go back to this. What has vehicle production in the early 20th century got to do with crypto? Well, let's just do this last thing. Imagine going back in time to America in 1908. So it's early September, and over the past couple of years, you've noticed an increase in the number of cars on the road, and you decide to invest some spare cash into this new industry because you think it's the beginning of something new. By the way, the Model T hasn't been invented yet, and you ask around looking for a company to invest in. So you're so overwhelmed, you guess there may be a handful, but to your dismay, once you start looking, you find in the United States alone hundreds and hundreds of companies manufacturing cars. Most of them are still steam-powered, although there's an increasing number of them moving over to gasoline. Now, here's a list of some of the American companies that existed in 1808. ABC Company, Abbott Detroit, Acme, Adams Farewell, Aerocar, Ajax Electric, Albany, Alco, Alden Sampson, Alan Kingston, Alice Chambers, Ultham, American Berylay, American DeLion, American Electric, American Gas, and American Juvenile Electric. Now, believe it or not, that's not even scratching the surface of the A's. There were a ton of companies to pick from, and it's exactly the same with cryptocurrencies. Which one do you pick? History makes it obvious. And the majority of people, 95% anyway, think that if they could only go back in time and purchase Ford Motor Company stock in 1908, or maybe Intel for under $5, or let's go back in time to 1986 and this new company, Microsoft. Let's go and buy shares on the IPO day. Or what about IBM in 1925? Or even Apple at a split adjusted low of 46 cents in 1987. So let's talk about Apple for a second. Obviously now one of today's massive, massive winners. But let's go back in time to 1997. Apple was in bad shape. In July that year, Steve Jobs had just been taken back on as a temporary CEO after being kicked out, air quote, resigning from the company 12 years earlier. In September 85, Jobs left Apple. But if you take a look, you'll see that Apple's share price at the time he left was down 77% from its high. But in response to Jobs leaving, Apple went up 752% over 2 years. Now, history tells us the success of the iPod and leading into the iconic iPhone. But how many of you remember the Apple Newton? In 1993, Apple released the Newton. This was a 1990s precursor to our smartphones. The Newton was a device that Apple thought would change computing forever. So does this sound familiar? A handheld computer with the ability to input handwriting via a pen. Brilliant. I have an iPad today. I'm sure probably you do too. Now, the Newton was being designed as early as 1987, but it never caught on. And when Jobs returned to Apple in 1997, what did he do with the Newton? He canceled it. He canceled production. Now, Apple wasn't alone in developing handheld computer systems. Only history tells us it was easy to pick Apple to do this. But go back in time. Does anyone remember Science? Cyan produced its first digital PDA, or personal digital assistant, in 1984. And it was little more than a pocket calculator. But by the early 1990s, Cyan's breakthrough product was a Cyan 3. I actually owned one. I remember buying one in London. By 2001, Cyan's PDA business, though, had failed. The operating system that powered it was renamed Symbian when Stein went into business with Nokia, Ericsson, and Motorola. And we all know how that ended up. But back then, it wasn't going to be that obvious. In 2007, when Apple released its first iPhone, Symbian was powering an estimated 125 million cell phones. Nokia used Symbian to power its smartphones until 2011, when it changed over to the Microsoft Windows OS, and we know what happened to that. So the first generation of mobile computing products, Apple's Newton and Cyan 3, both failed, and failed spectacularly. And it's not easy, without the benefit of history, to figure out the companies that will, in the end, become household names and succeed. So let's get back to this. Think of cryptocurrencies as a solution looking for a problem to solve. Most people waste time arguing on social media about which technology is going to be successful. But the true answer is nobody actually knows. So instead of focusing on the micro, when it comes to cryptocurrencies, stay in the macro. You'll be much better off for it. And let's talk about this. Bitcoin and Ethereum together make up, today, 65% of the entire cryptocurrency market. Bitcoin is a store of value. Ethereum is an open source, decentralized computer network. A what? Well, let's just get to that in a second. Now, instead of focusing on the tech, focus instead on real world problems. So can you think of a couple of recent real world problems? Back in 2015, I wrote this, quote, "A perfect storm. The stage is set for the introduction of a new technology. It's called a distributed ledger, but soon you'll know it by its other name, a blockchain. Arab Spring, popularism, trade wars, the rise of social media, the mass migration of people fleeing war-torn countries, extreme politics, tariffs on trade, and the rise of Bitcoin and cryptocurrencies. Not connected? Think again." So the investment philosophy is very simple. You find the driver of societal trends, and this technique comes from my art background, and that's it. It is as simple as that. Find the driver of the trend.
John?
Now, yes, mate.
John, we have a caller from the UK. Bozam is on the call with John Jameson. Go ahead, Moss. Are you there? Evidently not. We lost him. Go ahead. That's okay. We lost him, John. Go ahead. John, you can go. You can continue now. I hope we can. I should have known better. Anything technical, they should keep me away from it. Are we still online? I don't see any noticing coming through, and I don't think we've still have John on the line.
Just before you
I don't know what's happened here.
Hello, Larry.
Yep, we got you.
I'm back.
You back.
Put me off.
I'm sorry. Just keep going, my friend.
Okay. So far, I don't want to. This is what I said. I don't want to keep talking if people aren't interested in this. So
they are. They are. Keep talking.
Okay. If I had the dashboard up here where I could see the feedback coming through on the feeds, it's because basically what I'm doing, guys, is I'm talking into an iPhone, so it's quite difficult to see the feedback. So if this is interesting to you, it's going to get more interesting right now. I just wanted to lay up a background. But if you've got any questions, ping them over to Larry. And if I don't get a chance to answer them now, I'll answer them in an email after I've finished. You'll get them later on today or tomorrow. Okay, so are you okay, Larry? I'm going to carry on.
Go ahead. You're on the game, please.
Okay. Now, I just noticed there's no ads coming, but I'm just going to keep going. So I'll just back up a couple of lines.
We told them not to have any ads. This is too interesting. Go ahead.
Okay. So let me just back up. So basically, Arab Spring, populism, trade wars, the rise of social media, mass migration of people fleeing war-torn countries, extreme politics, tariffs on trade, the rise of Bitcoin and cryptocurrencies. Are they connected? Not connected, do you think? Or think again? So the investment philosophy I use is very, very simple. I find the driver of societal trends, and this technique comes from my art history background. And that's it. It is literally as simple as that. Now, 99% make this much, much more complicated than it needs to be. If you don't know what the underlying driver is, then it's going to be very, very difficult for you to not get out at highs. And then you're going to be out of position. You're going to have to time your entry back in. And you might well be comfortable with doing that. if you're a short-term trader. But if you're running another business like I am, then I like to get set, get entered, and I use declines to buy more, not to exit positions. So how do you find the zeitgeist? The zeitgeist is the driver of the current epoch or trend. So once you've found it, it's simply a matter of putting yourself in the way. So because you've come today, I'm going to tell you, in my opinion, what the driver of the trend is. I'm going to do it right now. So the edge comes from knowing that societal trend's primary underlying driver for at least the next decade, for the rest of the 20s, is a lack of trust. So let me repeat that because it's emphasis important. A lack of trust. Concept. If any idea is not in alignment with this prime driver, I pass. Now, I didn't guess about a lack of trust. I didn't go onto YouTube and somebody told me. I got down and figured it out. So let's have a look at this. With the rise of international tension since 2010, that is a quantifiable truth. I don't need anyone to tell me that. I can see that. I can see that recorded. So I postulated which would be more sticky in that environment, capital movement or democracy. Now, given that capital movement relies on the interconnected web of global supply chains, I estimated that it's much more likely that democracy would become a continuously monitored compromise over the coming years. Now, once this hypothesis was made, I then used something called complexity theory. In fact, I use my own fast and frugal version of it to monitor those events. So given that I believe democracy and therefore civil rights will, and you can see them going through a period of decline in the West, I ask, given my hypothesis is true, what is the likelihood my hypothesis is false, given the continuing weight of evidence as time moves forward? Now let's model risk. Assume that the world is made up of two domains, the uncertainty domain and the certainty domain. The certainty domain, where everything is known and all risk can be quantified, and the uncertainty domain, where all risks are not known and risk can't be quantified. Investing and speculating lives in the uncertainty domain. Most investors, if they do any analysis at all, waste time attempting to discover something optimal in the past, as if they're operating in the certainty domain. That's what you're doing when you're using charts and using data as an expectation of the future. But in the uncertainty domain, fast and frugal decision-making outperforms frequency statistics. In 2021, cryptocurrencies are still a solution looking for a problem to solve. And most cryptocurrency investors are searching for the killer app. I am not. I understand that the killer app comes second. What comes first is the infrastructure. Now, in our world, the infrastructure is the operating system. In the PC market, the killer app for the PC was the spreadsheet. And because the cryptocurrency market is still a solution looking for a problem to solve, the killer app in the distributed ledger market is still unknown. So instead of guessing, I invest in the infrastructure and monitor the market for the emergence of killer apps. Instead of searching for the killer app, put yourself in the way of the rollout of the infrastructure most likely to succeed during a period of time that is dominated by a lack of trust. And to do this, you need to understand the network model and how that's used to transmit data. The re-engineering of the internet means that inside the next version of the internet version 3.0, value will not be at the centralized layer 7, the application layer, but pushed down into the protocol network stack between layer 4 and layer 7. And layer 4, if you're not a network engineer, is where TCP/IP lives, or IP, and layer 3 underneath that is where IP services live. So in 2017, whilst working with Larry on TFNN, I wrote this. The internet is being re-engineered. It is happening right now, and not 1 in 100,000 understands the implications. It's a very big deal. When the internet re-engineering is complete, the mechanism will be in place to record everything you do. From first breath to last, it will be sold to the public as a technology that will keep them safe, and it will. But the cost, not monetary, will be huge. Internet 1.0 was read-only, allowing users to search for information and read it. Internet 2.0 is read and write, allowing users to participate and create content. Think Facebook, Twitter, YouTube, blogging. What's coming next with Internet 3.0 will solve one of the big problems for consumers who participate in Internet 2.0. It will allow them to own their data. Now, the Facebook scandal in March 2018 exposed social media companies for what they really are. You ready? centralized data harvesters reselling this data to advertisers to allow not only for precision-targeted advertising, but also precision-targeted influencing of certain demographics in society. Internet 3.0 will be sold to the public as a benefit, allowing them to control and own their own data. But here's what the public will not be told and do not fully understand. You might think that giving back control of data to users will harm Facebook and Google. It will not. And in fact, other social media companies, but mainly Facebook and Google. And it won't. Why? Well, because they have, anticipating this, invested in AI and have built their own automated avatar of humanity. Literally, digital deoxyribonucleic acid, DNA, created from your metadata. This gives them the capability to generate in real time from their metadata universe a clone of you, a synthetic avatar in real time, matching and anticipating your unique behavior patterns. Now, you might be thinking, hang on a minute, John. Whoa, let me stop you right there. This has got to be science fiction. It is not. It's actually real, and this technology is in place right now. Now, Internet 3.0 will give participants the ability to read and write, and here's the key, own their own metadata. And the key to unlocking what Internet 3.0 will actually do is the word own. To own your data, Internet 3.0 will need to execute computer code, and to execute that code means creating an event that can be tracked and associated with you permanently. Internet 2.0 built mega technology companies that received their raw materials for their business from you for free. Internet 3.0 will take this a stage further. They won't do it, you will. Just like grandma shared pictures of little Joey with the rest of the family, the public will opt to control their own data. And this will create an event that will connect you to your data, the metadata being attached to a distributed database. Now, you need to think of this as a permanent digital tattoo. Now, this isn't conspiracy theory, but conspiracy theorists have got it wrong, in my opinion. The government is not going to enslave you. You are going to do it all on your own. To put ourselves in the way of a move away from a centralized, non-tracking internet into a decentralized tracking internet, you're going to have to invest in certain infrastructure technologies. And the question then becomes, which one of those is going to become the standard? So without having access to Biff's almanac for Back to the Future, we don't know for certain. But the good news is neither does anyone else. 20 years from now, as we've discussed, it will be obvious. But in real time, right now, as events unfold, it's not as easy as you think it is to figure out the future. But I do have a secret weapon. So there are 3 computer laws to rule us all, and they are Moore's Law, Bell's Law, and Metcalfe's Law. So Moore's Law, named after Gordon Moore, the founder of Intel, states that the number of transistors inside a CPU doubles approximately every 2 years. Now, Bell's Law is a corollary to Moore's Law, named after Gordon Bell. He's the engineering founder of digital equipment, and he states that every decade you can expect computer systems to evolve and morph into different systems using smaller and faster computationally efficient machines. And then we get to Metcalfe's Law, Robert Metcalfe invented Ethernet. That's the technology that the industry standard mechanism of packing digital data and sending it over local and wide area networks uses. Now, just in case, I'm sure you know this, wide area networks, that includes the internet. So here's the key point here. Metcalfe's Law states the network effect of a system is proportional to the square of the number of connected users. And this means that the market value of a network is proportional to the number of connected users. Now, hopefully the light is coming on. How do you value a network? You use Metcalfe's Law. Robert Metcalfe, one of the original internet pioneers, is a rare mixture of engineer and entrepreneur. In the early 1980s, he co-invented Ethernet and co-founded 3Com. But he also taught his sales team to use a simple technique to sell the advantages of using Ethernet networks to his customers. Metcalfe's Law works like this. As you add nodes to the network, the cost of adding the nodes goes up linearly, but as the number of nodes on the network increases, the number of possible connections between those nodes goes up faster than the linear cost of adding a node, and it goes up as the square of the number of nodes. 2 nodes make 1 connection, 4 nodes make 6, 8 make 28, and so on. This is the kicker to the network's value. It goes up as the square of the number of nodes. If a computer has 10 nodes, the intrinsic value is 100. Add one node, the intrinsic value goes up 20%, and so on. Venture capital company NFX, who brought billions of exit value to the market, including Lyft, Patreon, and Flickr, investing in or advising over 300 companies that have gone on to create billions of dollars of value, conducted a 3-year study to find variables that influenced a company or technology's future valuation. One variable stood out above all others, the network effect. So NFX found that 70% of technology's valuation since the beginning of the internet boom in 1994 comes from the network effect. Okay, so that is a big deal, and that is what we are putting ourselves in the way of. So my investment plan is to invest in the infrastructure and benefit from the network effect's growth rate, the growth rate acting like a supercharger on my returns. As more and more people use cryptocurrencies, more and more nodes are added to the network, and that means more and more value will flow through the network. And that means the value of the currencies of those network open source decentralized infrastructure will go up, and it will go up parabolically compared to the cost of adding the nodes. So here's the thing. Just like the automobile industry 115 years ago, the cryptocurrency market has hundreds of potential winners and thousands of products. So let's imagine you landed naked back from the future with amnesia and no knowledge of what was going to happen next. Without history as a guide, picking out what is going to become the household name is much, much harder than you think it is. So out of all of the automobile manufacturers, most of them failed. And you might think it's different this time, and there's room for many different types of blockchains and tokens. But if you think this way, you're betting against history. With so many different coins and tokens to choose from, how do you decide which ones have a shot at surviving? And how do you make a choice if you're not a computer programmer and your computer knowledge begins and ends with Microsoft Word? Even if you're technically computer literate and your knowledge is good enough to use these skills to accurately target the coins and tokens most likely to succeed, which ones are going to? And sometimes even the best technology fails. That's just the way things are. So working life in the 21st century is highly specialized. Rather than concentrating on the technical aspects of how different types of distributed ledgers work, one technique stands out above all the others. Go back to the big idea. And the big idea behind blockchains is to trust no one central authority. Instead of a centralized system of trust used with central banking, banks, and clearinghouses, the system held responsible for financial crises, why not use a system that trusts no one? Why not democratize the process and use a community to validate transactions? So what makes a blockchain, and why is it different from a decentralized database? Well, the answer is the method of transaction validation. But how can you have trust in a decentralized database? How can you ensure that specific parties can't create dishonest transactions? This is the oldest problem in computing. How do you maintain a trusted database in a decentralized system? How can rogue parties within the system be prevented from manipulating the data entries to their advantage? Now, this is where we are teetering on the edge of the rabbit hole that is the geekery dark black hole. So, for example, what I'm talking about here is maintaining consensus between different nodes in a decentralized system. That's known as Byzantine fault tolerance. Now, blockchains like Bitcoin and Ethereum all use different types of Byzantine fault tolerance to validate their transactions. Bitcoin uses proof of work. Ether uses proof of stake and mining. But using proof of stake to run smart contracts on a platform is one of the big advantages of Ethereum. So one way to think about the Ethereum model is that it's used mining to build the platform, and it will eventually, and in fact this summer is beginning the process to shift over to from a proof of work to a proof of stake model, where the holders of Ethereum are able to put their stake into the network and be responsible for validating it. Okay, so this is one of the keys of scalability of a blockchain, and that is the cost of the computing power used to validate the network. Now, this is one of the big downfalls of Bitcoin. Bitcoin's proof of work data validation scheme involves the Bitcoin network setting a target value and the Bitcoin miners running algorithms to try and guess a number. Simplistically, the guesses the miners take are called hashes, but the business of Bitcoin mining is about being able to make as many guesses or hashes as fast as possible. And we now know that the disadvantage of this is the network validation model in terms of energy. It is absolutely massive. The Bitcoin network currently uses more energy than Norway. So how is Bitcoin going to get around this? is it going to get around it? Are we going to see a decoupling from Bitcoin into the altcoins? So if Bitcoin begins a new uptrend and demand returns to previous levels, what actions can you expect governments to take if that happens? So if you see what I'm saying, there are certain areas of the cryptocurrency market that are front and center going to hit problems. Right now in Bitcoin, this year in the UK is hosting the World Climate Summit. And of course, over here, we're getting ads now about, climate change. They're starting to ramp up. And you can expect Bitcoin to get bad press. But here's the thing. We're getting asymmetrical media news flow because Ethereum, this is the biggest news this summer, and another blockchain, Cardano, which has already, by the way, transitioned over to a fully proof-of-stake model and is over 1,000,000% more green, if you like, more energy efficient than Bitcoin. Why aren't we hearing about those information flows? And the reason that we're not is interesting. In fact, that's probably one of the main reasons why we are eventually going to go out into new all-time highs. Now, I can't believe that's 50 minutes. Earlier, I promised you a pick. If you haven't guessed already, that pick is Ethereum. Why? Because if you invest in the infrastructure of Internet 3.0, in doing so, you're putting yourself in the way of the network effect. As more and more people join that network, the value of that network and the value that flows across it is going to go up, not linearly, but parabolically. Now, one last thing I also said was, how do you know when Bitcoin is catching a bid? Well, the easy, simple, fast, and frugal way is to look at the premium to net asset value on the Grayscale Bitcoin Trust. And the symbol of that is GBTC. Now, cryptocurrencies are not just priced in dollars, they're priced in Satoshis. And the formula for this is the price of the Bitcoin Trust divided by a constant, which is 0.00940,746. And the quotient of that is then divided by the price of Bitcoin. That will give you the current price compared to the current price of Bitcoin. And right now, just before we started this, it was trading at a 9.4% discount. In other words, it's not bid. Okay, that's 53 minutes. Can I just give it back to you, Larry? Are there any questions?
Yes. Yeah, if you have any questions, folks, try to ask them right now if we can. And what we'll do is we'll have John on maybe in another month or so for a little pep talk here. And we're also trying to figure out some way to get this information out to you because it's really, it's folks, I'm not into this stuff, but, someone that has been telling me ahead of time what was going to happen to the market, really, you have to pay attention. So that's why I'm doing it. David's asking about crypto farming with hard drives. Is that available, John? David White's asking if crypto farming is available with hard drives.
That's the sort of thing that I would suggest you don't do, but that's only in my opinion. And that's a classic example of, the thing with cryptocurrency is, again, this is my opinion here. So I'm not saying that this is the rule and this is the only way, far from it. But my opinion, mining in Bitcoin, forget it. I would certainly suggest investing in it, but potentially mining, I think those days are over. The cost of crypto mining and the hassle of it. Of course, if you want to do it as a hobby, that's fine. But it's much more efficient to actually invest in the infrastructure rather than try and get some air quote, I won't say free Bitcoins because you actually have to go through the electricity cost to get them. So yeah, sorry about that, but that's really not what we're talking about today. So we're talking about investing in it rather than setting up a mining rig.
Yeah, how about getting further information on the research topic of cryptocurrency? How do you get information on cryptocurrency? Just going on the internet, or where do you get your information? Of course,
okay,
you're a little different than most people.
I'm whoever asked that question, I'm a professional writer, and what that means is I'm a professional researcher, and what that means is I spend a lot of time researching topics, and I'm afraid it's the internet, and that process is getting the internet is, as you probably noticed if you do any research, is getting more difficult to get information, and that's because Google and other search engines are serving up the same rehashed comment and quote stuff over and over and over again, just in different iterations. So the answer is I do a lot of research, but I'm also a computer engineer. So before I became a writer, I ran an IT consultancy business for 10 years in the 1990s. So my business was network security. So that's a field I understand, which is why cryptocurrencies, which is why I understood them. But even then, I was late to the party, or so I thought, but actually not so much. So yeah, I'm afraid it's just hardcore research. However, and I can talk to TFNN about this. What I've just gone through today is the tip of the iceberg of what you need to learn, and potentially there's quite a lot of stuff we can do based on it.
Okay. Yeah. God bless, and be safe over there.
Building wealth trading in the stock market seems